Welcome to Market Radar. We're not investment advisors, security analysts, or brokers. The following information is strictly for entertainment and educational purposes only. None of the information here is intended as a buy or sell recommendation. What's up, guys? It's another Market Radar podcast. Super exciting podcast coming up, both in markets and for our business. We have a new model. So now everything that was on our website, if you're familiar with that, is now going to be in a PDF report, which we're going to go through with you guys right now. And this is just going to be much cleaner, much more reliable, and overall just much a better experience for you guys. And we're going to be offering this. This report is going to be refreshing daily. It's going to be for the next day, So right now we're recording this on Sunday, but you see the date is Monday. So the data that's on here, you can review it Monday morning before market open. That's what we like to do. So it really gets you set up for the day on what to look for. And we're going to be offering this along with the weekly radar report and private Discord that we have, all for $25 a month. So that's our new model.
And the trading view indicator.
Yes,
and the
of course. Yes, the DDAP trading view indicator, the holy grail. You're going to be getting that as well, all for a measly 25 shekels a month. So yeah, let's go through it. We're excited to share this with you guys.
So on slide 3 here, we have what we normally was sitting on the website that outlined the economic regime cycle. Obviously, right now we're in stagflation, but this is a precursor to the entire report because some of you might not remember, some of you might not have ever seen this. This is the everything below in this report is built on the premise of what is described in this slide. So it's always good to go back, take a look at it, get a better understanding. This way, when you see changes happen in real time, you know what environment has historically unfolded in credit, specifically in the quality spreads and just the opportunity where risk is going. So this is slide number 3. It's important.
This is not like the underlying fundamental that our entire model is based on.
Right, and this isn't going to change. This is a stagnant. So this is once you memorize this, you can kind of just scroll past this. But again, it's always good to go back and just refresh. Now, slide 4 is going to indicate what the regime is, any upcoming economic releases for the day. So this is for this report is generated for Monday. So these are all the important releases as of Monday or for Monday. And these were the best 3 sectors, worst 3 sectors, top 3 factors, and worst 3 factors of the previous trading day.
Yeah. And as you can notice, the trend for utilities, XLU, the background of the cell is green. So what that indicates is the DDAP trend was bullish within the last 5 days and switched to bearish. So that kind of helps to understand when trends shift, because that's a pretty big deal when a trend shifts. So we want to highlight that so it's really easy to see when something has changed. And there's also, if it's
this is the big this is the big slide, the one that we show at the beginning of every podcast. This is the current regime, slide number 5. You're going to see the current regime, stagflation, the probabilities of all the other regimes, and the system strength. Under it, you're going to find a slide that sums up what the historical performance has been since 1990 based on the current for the current regime. So this is the current regime, stagflation. This is the historical performance, 1990. Now let's go to the sub-regime metrics. This is a new slide. Some are, if we haven't shown this in a podcast, I don't know if we have already. I don't think we have.
I don't think we have. No, I don't think. I think we've posted a screenshot of this before in the Discord.
Right.
But no, this was not on the website. This is new, and it's very helpful.
Right. So what this is basically outlining the sub-factors of each regime, which are defined as accelerating and decelerating growth, which we call risk on and risk off, and then accelerating or decelerating inflation. So risk on is an environment where pretty much everyone makes money. risk off is tricky. This is we're in the risk off regime right now, as you can see. We're at 71.8% right now. Now, these are basically in relation, the first two and the bottom two. So this is not a probability of all of these happening. This is the probability of accelerating and decelerating inflation, or risk on and risk off when you look at these probabilities. Now, the most important one being risk on and risk off, because that is the overall everyone makes money or everyone's about to get fucked. So that's why the chart below it is risk on, risk off, not accelerating inflation or decelerating inflation, because the risk on, risk off is just more important. As you can see over time, this is what the risk on, risk off looks like. And we are far away from any type of risk on pivot at the moment. Obviously, things can change, but this is a good thing to keep in perspective as we go throughout this volatile stagflationary regime. Next slide is the realized dominant system regime. This will update as the regimes update, and you will see TLT and SPY overlaid on the chart so you can get an idea of what has happened in the past. It's basically like our little quasi back test where you can look back and say, oh, okay, obviously red's deflation, so SPY doesn't do too well, but TLT on the other hand goes up. Makes sense, right? Deflation rates down, bonds up. This
Yeah.
is just something to look back on.
This is
This is
it's our bread and butter, basically.
right.
This is
Yeah.
what everything is all about,
Right.
and
This is
this is our moneymaker.
right. This isn't going to tell you what to do then now, though. This is not like a live data chart. This is more of like where to reference in the past. This is just something to get a better idea of what has happened historically so you can gauge on what would happen in the future. This is not, there's no real detailed regime metrics as of today on this chart, but it does update as the trends, as the regimes progress. So on slide 8, we have system strength. This is important because it gives us an idea of how strong the current system rating is. As you can see in the past, this goes all the way back to 2006. We are off the lows now from the mid to low 20s, and now we're back above 50. So a big bounce in system regime strength, indicating that stagflation remains here to stay.
Yeah,
The current point
essentially,
in time.
a way to read this is the lower the strength, the more probable it is that we get a regime shift. So if you're seeing high strength, it's a lot less likely that the system is going to switch regimes.
Right. That's a good way to sum that. So slide 9 is our basically our risk overview of what's going on from the yield curve, VIX forward curve, the estimated number of FOMC hikes and cuts, and the effective federal funds rate forward curve. Now, we're going to briefly touch on all of these so you have an understanding of what's going on. But on the website, there is actually a guide PDF on the Radar membership subscription page that you can just download a sample, and there are some guide bullets on what these things are. But for the sake of the podcast, we're going to explain this simply in that the yield curve is the risk within the treasury market. This is showing us how the treasury market is pricing in risk over time. An inverted yield curve, which are red bars, signals that there is a issue in the short term of the treasury curve that indicates that there are financial issues ahead of us. And the VIX forward curve is a graphical representation of where volatility is expected to be priced in the future contract expirations. Now, when the cash value or the current VIX index is above these values, it's what we would call backwardation, signaling that there is some sort of risk premium being priced into VIX today that is deteriorating over time. So there is some fear in VIX. This can get much wider though, but right now it is in backwardation. Now, we have the estimated number of FOMC hikes and cuts, and this is basically telling us how many rate hikes or rate cuts are priced into each of the following meetings. So this is this is in percentage terms. So if we look at the next meeting we have in November, what's up? In November we have 2.639 number of rate hikes because it's green. What that means is there's 200% chance of 2 rate hikes and
100% chance of 2 rate hikes. right?
Yes, 100% chance of two rate hikes, excuse me, and then a 63.9% chance of a third rate hike.
Yeah.
So there's 63.9% chance of 75 basis points.
And
Over
this is what the futures are pricing in right now, which so far during this hiking cycle has been correct about a month in advance at least before the
right,
Fed announces it. So it's
right.
very important to look at these.
And as we go out on the curve, we're not seeing any rate cuts being priced in the next 12 or so months. So important to watch this. If you think a Fed pivot's happening, you're going to have to see these cuts, these cut pricings pick up big time. We also have this type of data converted into a forward curve. So you could see where the terminals will be going forward. We're currently at 308 basis points for the effective federal funds rate, the spot price, and we're expected to hit a terminal of 445 basis points in mid March of 2023. After which it seems it's going to stick there for a while, and then going out 12 months from where we are today. So rates seem to be peaking March and holding steady until later next year. Now, this has been all over the place with the Fed hiking, inflation moving around. This can update widely on a daily basis, believe it or not. This can be up 20 basis points or down 20 basis points rather quickly, depending on what economic news is out. So it's always a good idea to keep an eye on where the terminal is and where it has been going over time. Over the past, I'd say 5 podcasts we've recorded, this has climbed substantially from the mid to high threes. Now we're in the mid fours. And just I think a week or two ago, we were in the high fours. So this has been moving up steadily. And then on the following slide, we have the um, basically the yield breakdown, or the correlations, I should say. This is the correlations page where we compare 10-year real yields versus gold, 10-year real yields versus TLT, VIX versus the Fed balance sheet, and SPY versus HYG total return. So let's go over each one of these quickly and explain what to look for when you see this chart. Historically, the 10-year real yield has a negative is negatively correlated to gold. Same with the 10-year real yield in TLT, meaning if you're seeing a rise in real yields in a percentage basis, so you were seeing real yields climb right towards 1.5%. Well, gold is going to have an inverse reaction, and what we're looking for here is some sort of divergence. For example, if real yields are going up and gold isn't going down, specifically what has been happening here. Unfortunately, the scope of this chart's a little tight to see this, but as time progresses, we go back a few weeks, you would have seen this a little bit better, and we have to keep it short so you could see the minute changes. Otherwise, it'll be a little hard to read. So going back, there was actually a point where gold disconnected from real yields, and there was an arbitrage opportunity to be had. Well, we know real yields are rising, so gold's going to shit the bed. And just in general, it's something we've been saying all year. Gold is lagging behind the move in real yields, and we're starting to see that play out. But this is just something to keep short-term eye on, so you understand where things are going. Same thing with TLT, inversely correlated, as you can see. When there's a divergence, usually it's not as bad as the one with gold, or it hasn't been. Bonds have been on the lows as real yields have been rising pretty much all year. So this is just, again, something to understand. If you start to see a major breakdown of real yields, expect bonds to move in the opposite direction. As long as real yields are rising, the bond trade is not there. And now this is an interesting one. It's VIX versus the Fed balance sheet. We've had a lot of tweets talking about how these are negatively correlated when the balance sheet starts rolling over. The volatility within VIX, or the vol of vol, starts going up. VIX starts becoming more volatile, and this is what we're seeing now as the balance sheet has rolled off its April highs. VIX is starting to edge higher again, and we expect more volatility or more whiplash in VIX as the balance sheet goes down in value. Now, this is one that the SPY versus HYG total return. This is an interesting one. We've had people tell us that HYG is not a leading indicator. We've had some would call it reputable Twitter accounts claim that this is this is a lagging indicator, and this is in fact not a lagging indicator.
This one's actually one of the best leading indicators out there.
Yeah, the fact that someone said this is a lagging indicator was quite funny. But This is something that we keep an eye on in terms of new lows. So, and new highs in the case of risk on, but we're far away from new highs in HYG. A total return, just to clarify, means adjusted for dividends, right? So it includes the rate of return with dividends. So when we look at SPY versus HYG total return, we're looking at SPY versus HYG dividend adjusted. And when HYG dividend adjusted is making new lows, SPY shortly follows. And this is something that we have kept an eye on in the past. Going back, if we go back a little bit further, again, it's very hard to show historically. You have to go to our Twitter. We have a bunch of tweets about this. HYG, when it deviates from SPY, is basically telling you that the bond market, the riskiest section of the bond market, is pricing in more downside, and SPY will usually follow, if not at the same time. HYG tends to make new total return lows prior to SPY in the last 6 to 12 months. There's been, I think, at least like 3 or 4 times where HYG printed new lows and SPY still had some ways to go. So it's just more confidence that the new lows get printed, and it actually just occurred again. This actually just happened a few days ago. I think it was here. No, was it here?
Yeah,
I
well,
don't know.
essentially, this slide is a massive alpha generating slide. You can have full on trading strategies based around these divergences of these charts.
Yeah.
And that's not what we do, but it's up to you guys to explore that, and there's definitely opportunity there watching these divergences, and that's why we include them in our slides.
Right. Yeah. That's a good way to sum it up. Now we have the aggregated historical regime returns. This is basically a chart that sums up the performance of each underlying in each regime, and the way it's stacked in a manner that you can see the biggest contribution of each regime within the specific underlying. So, for example, on emerging markets, we have we have the expansion regime doing real well at 5%, and we have the um, stagflationary regime doing poorly at what seems as negative 2.5%. So this is something to watch. You can get an overall understanding, but it's not going to update that drastically because it is going back to 1990. So don't think, obviously, every week that goes by or every month, so on and so forth, it's more contributing factors to the overall performance. But there's many years of data here, so this isn't going to shift so
Yeah,
quickly.
this gives an overall highlight, but then in the next slide here, we've got the breakdowns of each regime, which assets outperform and which ones underperform
Historically, yeah. Which
historically.
ones have which
And
ones have done, yeah.
yeah, these go back till 1990
1990
as
as well,
well.
yeah.
Yeah, and
Okay.
so yeah, we usually we like to play the big dogs, the highest outperformers or the biggest underperformers in each regime. Those are what we focus our strategy on. But there's tons of opportunity here in portfolio allocation, allocating towards multiple assets that outperform. Uh, it all depends on the individual's risk level.
Right. And then the final 2 or 3 slides are trends and performances. So these are just tables um, that go through, and you can basically see what current trend is indicated by DDAP, and what the performances have been the last few days.
Yeah, and
I mean, the
this
last day, last month. I'm sorry, not the
yeah,
last few
and
days,
and
and then
also
going.
comparing it to the SPY, because at the end of the
Yeah.
day, we're here to outperform the S&P. So it's very important to compare everything to the S&P. You can make money, but if you don't beat the S&P, you're shitting the bed. So everything is
Right.
compared to the S&P, and these final slides give you a nice overview of what's going on throughout all sectors, all factor exposures, commodities, currencies, everything.
Yep.
So
And that
gives
pretty
you a
much
good
sums up.
highlight.
Yeah.
Yeah, and that
That,
that sums it up. So we're super excited about this, and I hope you guys really enjoy it. And we're here to we're here to all make sense of the market, and this tool we think will really help a lot of people make sense of what's going on.
Right, and it's simple. It's updated every day, and it's in PDF format, so you don't need any advanced any type of computer or advanced platform to look at it. You can look at it on your smartphone. So I think this helps everyone from these models on the website that were a bit glitchy, not updating properly. Now we have everything in a PDF, so everyone gets a copy and everyone can look at it. On their bus, on the bus ride or train ride or car ride to work or wherever you are on a plane, you can see all this stuff. Pretty simple on any mobile device.
Yeah. So let's get into the rest of the podcast. Let's start with the calendar. Going into next week, we've got Monday, we've got quite a few Fed speakers on damage control. And we've got PMI manufacturing final, ISM manufacturing index, and construction spending. Tuesday, we've got more Fed speakers and factory orders and jolts. Wednesday, we've got OPEC meeting, ADP employment report, international trading goods and services, ISM services index, and the EIA petroleum status report. Thursday, we've got jobless claims, EIA natural gas report, and the Fed balance sheet. And Friday, pretty light day, we've got the employment situation only. And then we've got Fed speaker as well. So we've got Fed speakers every day of next week coming up.
Yep. And let's go over the recap of this week. So let's start with durable goods. The durable goods order came in at negative 20 basis points. So another negative print. And we are just hovering at the zero line. So this is not recessionary. This is not near recessionary levels yet. Excuse me. Go back to 2020, go back to even 2018, 2008. Like this is still considered somewhat positive, even though it's negative. It's not that bearish just yet. And durable goods core, excluding transports, is actually still positive. So again, not really a big decline here. Not something that is so quote as some would call bearish pointing. We had the Case-Shiller Home Price Index come in at a 16% year-over-year increase, 1.2% quarterly increase, and a 74 basis point 1 month decline. So something to watch. Home prices are slowly seeming to roll with interest rates going where they are and probably going to stay where they are for a while. The case here just remains bearish overall. Consumer confidence, the Consumer Board Consumer Confidence came in at 108, still well off the highs made in the last few years. So we're down there. We're down a bit, but we're not at lows. So something to watch. Kind of neutral. We have new home sales pushing up big in the last report. 1 week we are up in the last month we are up 28.76% increase. Last quarter a 7% or almost 8% increase, and 12 months we are down 15 basis points. So it's off the 12-month high, but we're not really in that huge negative territory just yet, which we've seen in like 2008, where we saw this climb all the way down to negative 40%. Even in 2020, this was short. Well, it was short-lived because of COVID, but even in 2018, we saw this stay steadily at 20, right above 20% before reversing and that whole deflation pivot. We are still not there. We're just hovering around zero. It seems we're off the lows, but I don't think the issues are going to be alleviated here, given that where interest rates are going and have been the last few months. Goods and trades balance of the deficit, we saw this climb in the last reading. We're still down 7 basis points in the last 12 months, down 15% in the last quarter, and down 3% since the last reading. So this is still overall declining, but it seems like we are trying to reverse and go higher. But in general, this is a declining figure from a year-over-year perspective. We have obviously the higher this goes, the better it is for technically for the dollar. But we're watching the dollar closely. It's at 2001 levels now. It's rip roaring bullish trend. So I would assume that this is going to continue to climb. Retail inventories excluding auto, came in plus 60 basis points above zero. So again, no real bearish sign there. home sales and the pending home sales is a shit in the bed. But still, again, not near the levels that we saw consistently back in 2007 to 2000, excuse me, 5 to 2008. Again, this is more of a financial home crisis than we have now. This is shitting the bed, but it's just not. It's rather quick, right? In the last 3 months, this
Well,
has spent
it's
years.
expected with the interest rate hikes at the
Right.
speed that they've been hiking. You're gonna see a speedy repricing across homes as well, right?
Right.
So
Yeah.
everything will react just as quick as the rates rose.
Right. And the question really isn't that we're seeing the pending home sales slide, which all this is homes that are, that are pending, right? The home sales that are pending. Um, we aren't going to see, the question is really not the decline, but how long we're going to see this negative 20% figure, right? Because here we
Yeah,
saw it for years. Here we saw in COVID, it was pretty much what, two prints, three prints, and back up. So the question is how long we stay down here. And that's what we're going to see. We're going to see how this unfolds. We had crude oil inventories come in at negative 215,000, back under zero. So this put three prints above zero after putting three prints below zero. So we're kind of just going balancing on each side. Remember what I said, or what I have been saying. It's a matter of where the cluster of prints are, not the number itself. So as the cluster of prints remain in positive territory, it is weak for crude. If this slides down, we get more negative clustering prints. Well, that's bullish for crude. We have the GDP growth rate come in at negative 60 basis points. So again, another bearish print here under zero. Something to watch. Again, it's not so much that this is negative right now because this can easily revert. It's how long we stay in negative territory that matters. Um, then we had PCE, one of the Fed's favorite tools that what they watch. We know Jay Powell loves this one. We're seeing this still up 6.25% year over year, 1.78% quarter over quarter, and rising almost 30 basis points month over month. So still positive here, not really breaking trend. I mean, it's definitely slowing, right, in ascension terms, but it is still what we would consider sticky. This is PC core, so this is excluding food and energy, same type of thing, remaining sticky and actually rising 56 basis points. So this is rising more than headline PC. So something to watch there, that energy and food aren't so much of an impact. They're more of a negative impact than they are a positive impact at this point. So we have other things that are going up outside of food and energy. That's going to be important for CPI as well. We saw that in the last CPI print too, though, where things like services were bringing in some more upward pressure than previously expected. So now we have United States personal spending month over month, positive again, not really falling off a cliff. And the cliff that when this does fall off a cliff, even in 2008, this COVID blowout just kind of fucked the whole thing up. It really doesn't go down past like 1%. So we're still at positive territory. So not really too bearish yet here. And then we have Chicago PMI finally breaking under 50. So something to watch here. Back in 2008, we bottomed 32. 2020, bottom at 32 ish. Even in 2016, 2019, this did roll over into 2019. It was pretty much trading in the negative, in under the 50 mark until COVID hit, when the shit really hit the fan. So we're not even that we're not that oversold here just yet. I mean, even though this doesn't trade, but you get my point. We're not overextended to the downside here just yet. So again, not extremely like, oh my God, the world's ending. Like this is capitulation. We had the University of Michigan consumer sentiment come in at 58.6, well off the 2021 highs, but still above 50. The watch here. And then consumer expectations, same thing, 58 above 50. But it did print one, two, three, four consecutive prints under 50 this year. So we're back above. So we'll see if this starts rolling over. Again, this is well off the prior highs in 2021, but this is not again like, oh shit, everything is defunct. It's in the world's ending. So
Which a
that's
lot of
where
people are making it seem that way.
right, I know. And that's important because what ends up happening is people are people are letting their biases dictate what they're going to do, and that's something we profusely uh, disagree with when we talk about biases. That's why they're so toxic, because people will look at something like over the weekend we have this Credit Suisse and the Credit Suisse thing. Again, we're not going to get into the concept of it, but the idea is that Credit Suisse is going to default, banks are going to go under, Fed's going to pivot. For some reason, everyone always has a road that leads back to a fucking Fed pivot. I don't know where this comes, but they design these things, and I'm not saying Credit Suisse can't go belly up, but I'm saying everything is going back to easy money, right? Because people have been trained to make money with easy money. And that's something that we're seeing. Everyone's got this idea of a Fed pivot. We've been saying since pretty much January, when the Fed or just after January, when the Fed started hiking rates, that the pivot ain't near. It's just not. We have to get inflation under control. People say, "Oh, inflation is going to be lower in a year." Yeah, it's base effects. I understand, but you have to let the Fed. The Fed's going to play their game, so we have to let them play their game.
Yeah, don't listen to the masses, because the masses don't know shit. They want what, it's just wishful thinking, you know?
Right.
They made their money with easy money. Why would they want that to go away? Everything
Right.
that they see, all the data points that they see, always points to a Fed pivot in their minds, because that's what they want. That's
Exactly.
Unfortunately, that's not the way the market works. We
Right.
just listen to the market. The market is not saying that one bit, and it's pretty evident. But a lot of people are blinded by their biases.
Exactly. And that's something that you have to really pay attention to. You know, it's easy to get caught up in a bias. It really is. You start speaking about something long enough. Like, again, just remember, we've been speaking about stagflation. Many of you have a stagflation bias, most likely. And it's not, and I'm going to lay it out there. Most of you guys are now sold on the idea that there's going to be a market crash. And that's not something that we intentionally have done, but that's just normal. You get into this environment where stagflation is consistent, it's never going to end. Market's going to keep going down, right? But it's stagflation until it isn't. So
Yeah.
you have to pay attention. When that pivot happens, you can't say, well, oh, what about A, B, C, and D, right? Well, at least we won't. You know, when there's a regime pivot, we have to look at it and say, okay, this is a regime pivot, and this is going to happen because this has historically happened. We're going to position our accounts for that. That's how we're going to do it. Again, you can have your own biases all you want, but I'm just telling you that you're going to get caught up into an environment if you keep feeding these biases where you become what's called a perma bear. For a reason, the perma bears exist for a reason. They start with one bearish bias and eventually progresses to a lifestyle, to a market, to a whole scope of like market viewing. Everything is bearish forever.
Yeah.
Like, you know, you have people on Twitter that have been calling the the S&P crash since 2016. Like, this is, you know, it becomes ingrained into your investment process, and that's toxic. So we have to always keep an eye on that. But let's go into ES and let's talk about what happened this week. So ES is well off Momo. We got about 17.8% upside from here to Momo. So big squeeze potential. We have new 52 lows printed on Friday in the ES futures. These yellow lines on the chart are the strike prices that I purchased calls for that expire on the 14th for the public account for upside protection. The reason I did this is because of the way the way this has declined violently. I wouldn't be surprised if we can get a move to upper vamp. Momo would be crazy, but upper vamp is only 9. I say only, but when VIX is trading at 30 plus, 9.57% from here to upper vamp is not that crazy.
Yeah, and well, especially in this stagflationary environment, it's definitely realistic to see a false breakdown to 52-week lows, get everyone in short, and then squeeze the shit out of them.
I mean, we've seen that happen how many times here, right?
Yeah, exactly. Just when everyone thinks everything's going to collapse at new 52-week lows, it reverses right in their face.
Yeah, or you get the plunge and then the reversal. Plunge and then the reversal. Now we got the plunge. Do we get a reversal? I don't know. Listen, this is like you could make it that simple. Plunge reversal, plunge reversal, plunge reversal, most likely. But that's fairy dust. All that matters
that's
is
a fool's game. You can't.
Yeah, all that.
Like, it's random. It's gambling if you do that.
Right. All that matters is we are short in the portfolio, and we bought some cheap protection to hedge in the case of an event. If the market shits the bed, we still make money. So as long as like we don't get like some sideways shot, realistically, this is how we would get hurt. or not hurt, but the protection would be worthless if we do the sideways chop and then we squeeze. Possible, definitely possible. But um, at that point, I may again add if we're chopping sideways at lows, I may just add more protection when this expires. For the amount of protection that is put on, it definitely protects the portfolio to the upside, but leaves us open for profits to the downside. That's what we want to do. We've been saying this all year long. Stagflation will fuck the bulls and the bears. What would it seem simultaneously, where you have the market going down, bears are screaming, bears are cheering, the market going up, the bulls are saying the lows are in. This is what has happened all year, and I think that um, again, that's not going to go away unless the market really pukes aggressively. Because as long as the market doesn't puke aggressively, it's the idea that, oh, we're bottoming out. It's just something that people are going to constantly think about, like chopping around 52-week lows and reversing. How if I tell
That
you right
sounds like
now,
Max Payne to me.
that is max pain, right? But
Yeah.
chopping around 52-week lows and reversing, I'll tell you right now, you're going to have the double bottom crew chirping on Twitter like crazy,
Oh yeah.
right? So again, this is what psychology. You have to understand what people are going to think if something happens, and as long as the regime tells us otherwise, we stick to the regime. Very rarely does consensus Twitter get anything right. So just that's why people are fading biases, but um, everyone seems to be more and more bearish, and obviously anything can happen, but the odds of the market just shitting the bed straight in a row when everyone's bearish are just not the same as when people are aggressively buying the dip. That's why when everyone gives up on buying the dip is when the dip actually is formed.
Yeah.
So
And
that's capitulation.
that usually happens once something starts breaking.
Right.
Get massive down day, probably a circuit breaker. Who knows? But it's going to be bad. And that's usually when we can start seeing a recovery.
Right. And that's that type of analytical bias of like looking at what consensus is doing. That's really just a personal view. The system says stagflation, risk off, and that's how we're going to stay. We're going to be hedged just in case we want to do that double fuckery that's been going on all year. Other than that, risk off. Stock prices go down historically, so that's how we're set up. How the rate that they go down, obviously, we're only down. I say only, but we're down 24.51% year to date.
Yeah, we're down a quarter.
We're down a quarter year to date. Now, this isn't a quarter. This is 9 months. You have to realize we were down. If we take the peak, if we take, let's take the years open here, January, January, right here. We'll go right from here. We're up here. It's not going to be exact, but we were down 23% 3 months ago. We're down 24.15% now. 24.51%, excuse me. So we're only down an extra maybe 1% in 3 months. This is stagflation, right?
Yeah.
Where like
No
the
clear
market,
direction.
yeah, the market's slowly grinding lower. Like it's not like we're down 24% here. This was 6 months. Based on this type of straight again, markets don't go in a straight line, but like this could be down 35%, no problem by now if this type of momentum kept up, but it's not going to keep up because of stagflation. Deflation, on the other hand, that's where shit really gets ugly, and like that's that then all bets are off. But um, we are not there yet, and we could see that by bonds. Like again, this no bullish trend in sight. No
Yeah.
bullish trend.
Yeah, we still got quite a ways to go, but we are seeing a bit of a reversal happening this past week.
Yeah, off the lows. Yeah.
Yeah.
Um,
Could this
that's
be the
something.
bottom? Maybe.
I mean, yeah.
But
You want to take? I wouldn't take a bet on it though.
that's not a good risk to reward bet to take.
No, it's really not. I mean, look, Momo is 10% higher here. Cool. Yeah, whatever. The bond, the bond lows, like at some point the Fed's gonna crush it. This is the problem. Everyone believes that at some point the Fed's gonna have to crush interest rates. They will. I believe that too. We all understand that the Fed is gonna have to reduce the federal funds rate at some point, and they're gonna crush interest rates and bonds will be a buy. The problem is does the Fed bring the federal funds rate to 5 or 6% before they do that? And does TLT go to like 90?
Yeah, exactly. And
It's at 102 right now.
That's
Just
just
remember,
not a smart gamble to take.
right? It's at one. TLT's at 102. Just remember 102. What's 90 from here? Is it really that? Is like in this grand scheme of things? Is it really that crazy?
Yeah, no,
No.
not at all.
Based on what's been going on, people were saying at 130, people were saying, oh, TLT's bottom is like 115, right? Remember that? Let's even just bring back the time back here in early 22 earlier this year when people were talking about some type of trend line. I think it was this type of trend. I'm just going to draw something stupid on here just to get the idea. It was something like this. Something along the lines, oh, bonds are going to bottom here. Yeah, it's like it was around 120. Oh, I'm sorry, I got dividend adjusted on. It was around like 130. I remember this 120,
Hmm.
130. Everyone
Yeah,
was talking in March or April that the bond dip was going to be held up by a trend line, and now we just totally blew through that. And that again, where are the lows in bonds? Because I can't tell you. I can just tell you that bond risk to the downside remains extremely likely. So we're going to stay away until we have risk in our favor for the direction we want to play. Then like buying it is a fool's game for
yeah.
us.
Well,
Um,
essentially, buying this, you are fighting the Fed. That's rule number
yep.
one. Do not fight the Fed. Simple
Yeah.
as that. You can beat around the bush all you want, but you stick to that rule and you're going to avoid a lot of headaches.
Right. And let's talk about the pound quickly too this week. That was a big unfold on Monday where it fell 432 basis points. And then proceeded to regain pretty much all of the last 2 weeks or week and a half of losses. Now, this came with the BOE intervention where they are basically stepped in and they pulled a BOJ. Historically, interventions aren't bottoming, so I don't think the BOE can really stave this off, or the BOJ. Both of them can stave off such a decline by just unloading the United States Treasury holdings or cash in to convert to pounds to basically stave off a decline. More so though the BOJ, right? Because the BOJ, for example, they think about it like this: the BOJ is coming in to intervene with their currency to raise yen by selling dollars, right? But they're raising currency for a currency that they're just endlessly conducting yield curve control with.
Yeah,
So
so
it's
they're
like
they're constantly devaluing their own currency.
yeah, so it's like you're gonna set like it's almost like a catch 22, right? Like you're gonna devalue your currency with yield curve control, but then you're gonna try and revalue it by selling. Like it's almost like you're gonna try and stop what you're already caught. It's like okay, step one goes one step forward, but I'm gonna try and reduce that one step forward with one step backwards, but like we're really not going anywhere. Like it's like okay, well, like if the people don't like the currency and they start dumping it, like no matter what intervention you do, you have to unload all the U.S. Treasuries, and that's like 1.2 trillion dollars of Treasuries. That's fucked for the long end of the curve, because if they unload those Treasuries, just expect rates to keep ripping.
Yeah.
And this is like a big forex risk we have right now with all these countries that are trying to fix their domestic problems by selling foreign securities. Well, to us, we're foreign to them, so they're going to sell their foreign treasury holdings. And Japan is the biggest holder of U.S. Treasuries on a central bank basis. So that's not good for the long end of the curve. So we're not long bonds, so we could give a shit less about that.
Yeah. Well,
Um,
this is all stemming from a high dollar, pretty much, and we're
right.
not even in deflation yet.
I know
Imagine when
that's
we hit
crazy.
deflation, which is bullish for the dollar. We're not even there yet.
I know
If
this is the
if we
dollar right
do
now.
if we do get inflation reversing and we get deflation coming in, we could easily see 120.
Yeah, that's not
Maybe
even the
even
20.
125, 130.
What's what's
It could be bad.
what's crazy about that is just a few weeks ago we had a podcast of the dollar going up. We had a podcast, I think it was 2 weeks ago, or the two podcasts ago, or three podcasts ago, when the dollar was trading like here
Hmm.
at 109,
I mean,
and we
we've
were
been
talking.
saying buy cash for the last 6 months.
I know, but we just made a podcast about it where we said that if anything happens to the yen, the euro, or the pound, the dollar's going to rip. And it's crazy how quick this thing has gone. We just had back on Monday when the let's go to the daily. We are on the daily. Back on, what is it, Monday? I think the US, yeah, we were almost at 115 on the DXY back when the pound shit the bed.
Hmm.
That's crazy. We were talking about the dollar at like a 110 price a few weeks ago. Things up
Yeah.
5% or more than, or a little under 5%. But
And
yeah,
do you see this reversing anytime soon, or are we expecting this to continue for a while?
that's a good question. My answer to you is the problems with foreign currencies, foreign governments and their central bank issues, and the demand for dollars real resilient. So that alone is a bullish factor. And at the end of the day, the trend is stays green. So higher we go. you
Yeah, bullish
know?
trends lead to higher
Oh,
prices.
yep. That's an old saying. You can find that going back well into last year, where we talk about things that are going up, stay bullish. Excuse me, things in bullish trends print higher prices, and bearish trends lead to lower prices. So bullish trends lead to higher prices, bearish trends lead to lower prices. And let's finish off the podcast quickly talking about the yield curve, because I mean the real yields. Maybe this we have had questions about real yields. Some people don't understand what they are, and I think this can help some, or basically round out some of those questions. So I have on blue here. This is the 10-year real yield. And I have on orange here, this is the nominal 10-year yield, 383 basis points as of Friday. And on white, we have the break even. So the real yield, the blue line, is determined by taking the orange line subtracting, excuse me, the white line from the orange line. And that gives you the blue line. So,
So as we see break evens come down,
right. We
increases
see,
that spread.
right. Now, what that basically is telling you is real yields are rising. Obviously, nominals are up too. Okay, but the reason real yields are rising is because break evens are off their highs. And we've had some questions about this saying, like, oh, break evens are indicating something is coming. Yes, in some ways they are. They're going down, signaling that the inflation. Well, again, I think I have to explain what break evens are, because some of you might not understand this. So the break even is the market pricing of what inflation is going to be annualized as over the term. So for 10 years, the average rate of inflation is priced to be at 2.15%. Back in June or March of this year, excuse me, we were at 2.98%. So we're well off the March highs. Yet nominals keep ripping. And this is because the Fed has more control over nominals than they do of break evens. So as the Fed pushes, not because the nominals are more closely linked to the federal funds rate, the break evens are just more like tips and market pricing, and tips are under 10% of this total size of treasuries. So
Hmm.
more money trades on nominals than it does on tips, right? Just because, again, people, when you go and buy a bond, most of the time you're going to buy you're going to buy a government treasury, most people aren't buying tips, right? So in the term where the Fed, or in the case where the Fed controls nominals as they hike the federal funds rate, break evens can go the opposite direction. Meaning, if break evens fall down to 1.5, right, or 1 point, yeah, pretty much 1 point, we'll call it 1.5, and nominals stay glued, and even if they roll over to 3.5, right, we're talking about a 60 basis point move down in break evens, but only a 30 basis point move down in nominals, which in turn is going to boost this by 30 basis points, right? Because 60, a change of 60 and a change of 30, the real change is only 30. 60 minus 30 is 30.
Hmm.
That means real yields are going to go to 1.8, even though both are falling.
Yeah, and that's an inflationary sign still,
Right.
right? We need to
That's,
see
yeah.
real yields reverse and go downward before we start seeing deflation.
Right, and that's important to understand. Remember what we said in the slideshow at the beginning of the podcast. Their real yields are negatively correlated to both TLT and gold. If you want the TLT and gold play to happen, this has to peak. But if break even shit the bed and nominals stay relatively glued higher or chopping sideways, this is going to just continue to go up.
Yeah, we're
And
gonna
that's what
we're gonna see ZN get crushed even more.
right. That's why we just stay away, because it's just not the right regime. Realistically, what would happen is the system would pick up in a regime pivot prior to or at the time, or between the prior, at the time of, or shortly after real yields peaking. That's the system would pick up on this. The
Hmm.
system's not going to pick up on this breaking down when this goes like, all the way back to like early May or early April prices. The system's not going to be like, oh, it's deflationary time. Just to give some context here for those that don't know anything about the system flipped deflation early 2019. Let's go to real yields. Early 2019 was here. So real yields had ways to go lower.
Yeah, and that is the long bond trade when that
And the long
happens.
gold. Yep, long bond and long gold. But
Yep.
I think that's where we're going to finish off this podcast. If you have any questions, feel free to reach out to us on Twitter at the Market Radar. We hope to see you guys next week and in the Discord. Have a great week.